Hi guys, welcome back to the channel. My name is Dave. In my last video, we talked all about income ETFs and put a whole portfolio together. It looks like this. So if you're all about the income, this might be a good video for you. But a lot of people ask me, is this the right setup for me? And honestly, for the vast majority of people, my opinion is no, that's not right for you. You have to have a use case. You have to want that income. It's got to be the right situation. For most people, I would say simple investing into simple like index ETFs like the S&P 500 is going to result in lower fees, a better tax situation, and a higher overall return. So I'm going to show you that today as we compare some covered call ETFs versus the S&P 500. I'm also going to show you a simple portfolio setup with M1 Finance. This is something I've been using for about 5 years now, and about 2 years ago I started up a very simple 3-fund portfolio that's blossomed into about 6 or 7 funds, but still very simple. It's going to be more tax efficient, and I think will give you a better return. Very simple investing. So if that is what you're looking for, please stick around. Whoop. So over the last several years, we've seen a ton of covered call ETFs come to market, and that's what I want to focus on today. So we've been looking at lots of different ones, and in that last video, we saw a lot of different products, and some of them don't even correlate to the stock market, and they might have a good use for you in a retirement account to spin off some income and reinvest those dividends or distributions back into other products. I think that could work out pretty well. But when it comes to the covered call ETFs, even in a retirement account, we're typically going to see a little bit of underperformance. That's how they're built. That's how they function. As soon as you sell a call against something, you're capping your upside. And during a bull market, that can harm your return. And over the long term, I think you will have a better return with a straight ETF like VOO. So today we're going to look at JEPI, which is the JP Morgan Equity Premium Income ETF. We reviewed it before. I'll link that up above. Returns about 9% annually through distributions. It sells out of the money covered calls. It's a good product. I like it in certain situations, and I'm an owner. I also own VOO. That's the Vanguard S&P 500 index that they offer. There's plenty of other alternatives. That's the one I tend to buy. And I want to compare these two now that JEPI has been around for about 3.5 years. And I want to see how the performance has been and how JEPI is holding up. So let's take a look and see which one's best. And what I mean by which one is best is which one is best for you personally. So some examples might be if you're in your 20s, 30s, 40s, 50s, maybe even 60s with a long time horizon until retirement, you want to be something that has a low fee, a better overall return in the long run, and maybe more volatility, right? Those ups and downs are going to work in your favor. You're going to buy at those lower lows. Or maybe you're somebody that is very wealthy and a 30 to 40% stock market swing, while it's painful and disruptive maybe a little bit, allows you to move some things from one asset class to another one, maybe bonds back into the stock market, and allows you a better return because you still have time. Or maybe you're a high income earner, doctor, lawyer, you make a lot of money and you don't need to exacerbate your tax situation, so you want to kick the can down the road. And what better to do that with than something that does not give you a lot of income? It's going to allow you to have a better overall return. So those are 3 examples where I would say you're going to do better off in something like VOO versus JEPI. But as they say, the proof is in the pudding. So let's take a look at JEPI versus VOO. And we're going to use Portfolio Visualizer, which is free to sign up for and a great little program. Check it out for yourself. And it is important to point out that JEPI doesn't own the complete S&P 500. It only owns about 100 stocks that it selectively picks out of the S&P. So that is one factor as we're comparing these 2 products together. So I plugged both of our products into Portfolio Visualizer. We're going to backtest this portfolio of 1 ETF each to see how it performed. Now, JEPI has only been around for about 3 years. So we're going to look at all of 2021, 2022, and 2023. We're going to invest $10,000 into each product, and we're going to reinvest all the dividends that we've received over the past 3 years to see how they compare. So again, VOO, the S&P 500, 100% versus JEPI from JP Morgan, covered call ETF, 100% into each one. Let's see how they held up. If we come down here to the performance summary, and I would say right off the top, they performed exactly how they should historically. Especially when it comes to the S&P 500, and JEPI has performed well for what I would expect from a covered call ETF that is built like this. So that can of course change, but let's take a look at the results. We got $10,000 invested into VOO. It ends up at $13,309. That gives us a compounded annual growth rate CAGR of 10%. Right on the money, 10% over the last 3 years. And JEPI comes in at $12,872 or 8.78% for the CAGR, compounded annual growth rate. So we're giving up about 1.25% over the last 3 years by investing into JEPI. But there is a trade-off. What do we get for selling these covered calls and maybe reducing our overall return over a 3-year period? Well, we get all this other great stuff to come here. Our best year was up 28% for VOO, up only 21%. Still a good year for JEPI. But look at that worst year. Look at the protection that we get in our portfolio. Down 18% for VOO, down 3.5%, a dramatic difference for JEPI. And the max drawdown too, very impressive, right? 24% drawdown, and VOO only 13% with JEPI. So in my opinion, JEPI is doing exactly what it was built to do for the right people. It's a great product. You give up a little bit, right? But your highs, as you can see in the chart here, it's the red line for JEPI. The highs aren't quite as high. The lows aren't quite as low. And overall, you get a nice return from both products, but you're giving up a little bit. Now that might change. I'm sure we could find a period in time here where JEPI is going to outperform, and it might do that for 1 or 2 years, even 3 years. But this, I think, is more indicative of what I would expect to see from these two products over time. So you're giving up a little bit, but you're getting portfolio protection for that cost. Okay, so roll down here again. Annual returns, you can kind of see same thing in this bar graph, illustrating how high it was in 2021 for VOO, and JEPI was trying to keep up, right? But then VOO got killed here back in 2022, and JEPI held on pretty well using that covered call strategy. And then again, great outperformance in 2023, and JEPI had a nice little return as well. So that's kind of what I would expect from these two. And we're going to look at a couple others that people have talked about before. But before we get into that, let's scroll down here and look at the portfolio income and understand what's going on down here. So from an income perspective, you can see the discrepancy between the two. In year one with VOO, we get $159, then we get $176, and then we get $192. Paltry compared to JEPI, which has given us $771, $1,286, and $1,032 in year three. Very large discrepancy between the two. Now, I want to get into the head of somebody that's doing this on a taxable account. So let's suppose you have a use case for this. You want to pay your gas bill, right? You're going to treat this, instead of buying that, apartment building and going through all that headache of renting it out and all that kind of thing. Your perspective is, I'm going to buy JEPI. I'm going to take that 8 or 9% distribution, and I'm going to pay my taxes, and then I'm going to go off and I'm going to pay my gas bill. That's a real use case. So if that's your use case, yeah, have fun with it. Build it up a little bit. But understand that from a tax perspective, it's going to fall well short of what VOO is doing by sheltering the income for you. So I guess that's where I'm coming from when I start looking at this. So these small dividends, which are true dividends after 60 days, again, I'm not a tax expert. I'm not giving you tax advice, but after 60 days, they should become qualified. All those dividends that you're receiving are true dividends. So you're going to probably fall into that 15% tax rate, maybe 0, maybe 20. Right? Each year you're going to do that. You're going to pay your 15%, let's suppose. Whereas if you're making decent income on this income, this is going to be short-term capital gains, which will roll over to your ordinary income because it's going to be option income primarily. There might be some actual dividends that come through that as well. But it's primarily going to be short-term capital gains, which means you might be in the 35% tax bracket. It's no different than really your W-2 income. So let's say you're a good earner out there. You have a good job. You make a lot of money. So let's say you're in the 35% tax bracket each year. That's going to be a significant bite to what you're making off of this, right? You're going to have to pay those taxes. So 15%. Now I'll put up right now the two different categories this could be in, right? Long-term capital gains on the left side, I suppose. And on the right side, I'll put up short-term capital gains, or what will roll over as to ordinary income. So if we're looking at a difference between 35% and 15%, that's about 20%, right? And maybe you fall into a slightly different category. But that 20% on about a $3,000 gain over 3 years, that's $600, right? $600, that's an extra, just rough math, about 2%. So if you consider that 2% on top of that 1.25% 3.25%. We're over 3.25% difference between these two products, although they've performed relatively close to each other because of the tax consequences that we're dealing with. So something to keep in mind if you go through this. And I'm not saying, again, that it's a bad idea. It's just something that you have to understand and make sure you take into consideration when you're comparing these two different products. And one more thought on taxes in these two products before we move forward. If we extend this out, this is 3 years, but what if we go out 7 or 8 years? Essentially with JEPI, you're paying your 35% maybe, as an example, as you go. So that's all been paid for, and when you go to sell this, your basis probably won't be too far off. You probably won't owe much more. But with VOO, you're paying that 15% or so, right? Maybe 20%. But maybe you carry this into retirement, and then your income actually drops, and you drop into a lower tax bracket, and you're no longer paying 20%, you're in 15%. Or you're not in 15%, maybe you drop all the way to 0. And you can take all that as a tax-free gain. So that's one more thought too, as you carry your thoughts forward and you still have this VOO in your portfolio over a long period of time when you actually will exit that position. And I have one other quick comparison for you because I get asked about these products a lot and why I'm not a big fan. In this case, it's XYLD and QYLD. So these are two products, similar makeup. They sell at the money calls against their index. They spin off about 1% of distribution each month. Again, not very tax efficient if you're in a taxable account, but it pays you about that 12% a year, and people are attracted to that, but it's not a very good product in my opinion. And if we scroll down and look at the performance summary over the same period of time, we're going to see that laid out here. So again, we get that 10% CAGR from the S&P 500 versus 5.32%. That's with everything reinvested back into the product after you pay tax if it's in a taxable account, versus 3.13% for QYLD. So that's the worst of the three. And you can see that outperformance here from just owning the S&P 500. So imagine after 3 years, you just went out and you just decided to sell a few shares of VOO. You're going to be well ahead of these two other products. So not my favorite. So with that said, I'm clearly in the camp that you should keep your investing simple, especially if you've got that runway till retirement, or you're a wealthy person, you have high income. If you fall into those different obvious categories where you don't need the income yet, I would keep it clean and keep it simple. So what you see right here is an M1 account that I started 2 years ago. Very simple, as kind of a proof of concept for this exact kind of thing. So all I did was I went back and I plunked down $1,000 back in 2022, the beginning of 2022. I put $100 in every single week since, and you can see that we're now at about $13,000 with a $1,280 gain, about a 20.83% return over 2 years. So very close to that CAGR of VOO. So how did we get there? What did I actually invest in? And are these tax efficient products or are these income ETFs? Well, I'll tell you what, this is an after-tax account, so it's going to be tax efficient products. So we scroll down here, we're going to see exactly what it was. And I started out, honestly, with just a Boggle 3-fund portfolio for the first 6 to 12 months. And if you're not familiar with that, it's the combination of something like VTI, VXUS, and BND. So that's the total stock market in the United States. This is everything outside of the United States. And this is a bond fund, very general bond fund. That combination is a version of the Boggle 3-fund portfolio. And there's a bunch of different versions. But that was my starting point as my proof of concept and keeping it as simple as possible. Then I decided to branch out a little bit. I actually did a video on SCHD, XLK, and XLV, and how I like that combination. And that's coming up on a year here soon. I'll link that video up above if you want to watch it, but I really like that. So this is SCHD, which is all about dividend and dividend growth. XLK is all about technology, and I think you need that, especially if you're a younger person. Use XLK, VUG, VGT, some of these other ones that are offering great growth. And then XLV, because I think we're always going to need healthcare. And XLV did not perform well last year. All the more reason that I bought about $60,000 or so, I think, a few months ago, because I'm a big believer that it's going to be there in the long run. And despite its 2023 performance, I'm believing that 2024 and beyond will be very good for the healthcare sector. So that's where I'm putting some money. And then down here, I also have SPHY, which is a high yield dividend product. That's my only high yield one that's in here, but very tax efficient, and you can see the results. Pretty decent, pretty much in line with what we saw with VOO over 3 years, but this is over 2 years. About 10% a year, right? Compounded annual growth rate. So that's what I would be doing. I would probably steer away from a lot of those income ETFs until you get to that point where you want to. So I'm 52 now, and I've started to buy a few because they're kind of fun. But again, I realize that it's not the best product for me still until I get a little bit closer to retirement, unless I'm using it as some sort of income replacement right now. So I am a big proponent of what I call simple, easy investing, and I think M1 Finance does a better job than just about anyone of teaching investment fundamentals with some of the things they've got wrapped up in their products. So if you're brand new, it's a great one to sign up with, and I've got a referral link down below. You can use that. I think I get a nice big benefit out of it, but I don't think you get anything. You might. You can check it out. But if it works for you, great, sign up. I still do a lot of my trading, honestly, on Fidelity and E-Trade, but I've been pouring money slowly into M1 Finance because I'm kind of hooked on their product. I like it a lot. So anyway, buying these simple ETFs and building off of that, I think will have great returns for you. And I know from my personal viewpoint, I'm great at building things, businesses, buying real estate, investing in things like that. As far as being a stock analyst or a financial analyst, it's not really my thing. Give me an income statement, give me a balance sheet, I'll read them for you, but it's not my area of specialization. There's lots of people that are much better than that, and I like to lean on them. So in that case, buying simple ETFs and things like that for a lot of my investing works well for me. And that way I can focus on my job and my other things. Anyway, I'm getting off task here, but that's kind of where this leads to. So if you don't need the income, look at products like this and a simple setup like this, and that would be my answer. Not financial advice. But anyway, thanks so much for watching. If you like this type of thing, like and subscribe, and give me some comments down below. We'll see you next time. Have a great day. Whoop.